So I'm George Kiadopoulos, Director of the Institute of Finance and Financial Regulation, and I would like to welcome you all to this online international conference on ESG, which is organized by the Institute of Finance and Financial Regulation and the European Bank for Reconstruction and Development. We are thrilled to have more than 1,000 delegates registered, and we hope that you will enjoy it. Delegates are coming from all over the world, so good morning to US, good afternoon to Europe and Northern Africa, and good evening to Asia and Australia. For those of you who are not familiar with IFFR, let me spend a minute navigating you through the scope and activities of the center. So IFFR is an international research center founded under the auspices of the Department of Banking and Financial Management of the University of Piraeus. Its scope is to bridge the gap between cutting-edge academic research and the needs of the industry. And to this end, we have formed a team of distinguished academics and professionals from leading universities and organizations around the globe. So academics are coming from universities like University of Chicago, Northwestern, Cornell, UCLA, UBC, Yale, LSE, Imperial, Queen Mary University of London, City University of London, University of Vienna, and other academic institutions. And professionals have shaped the practice of financial markets and their institutions, serving in institutions like Goldman Sachs, Citigroup, George Soros Fund, and in various hedge funds. IFFR builds its activities on three pillars. The first one is that it acts as a think tank forum, so it offers to the public events like today's. So we're not an event organizer. We tend to think of ourselves as a think tank forum, and in addition, we have two more pillars. We offer executive training activities and consulting services. A few words about this ESG conference. Given the scope of IFFR and the activities of EBRD, we could not be absent from the public dialogue on this very hot and timely topic. So we joined forces with a leading institution like EBRD, and we composed a high quality program. So we have distinguished speakers, both academics and professionals from leading organizations. So this again echoes the scope of IFFR. We're going to have a 2 days conference for the purposes not to tire you. We know that we all attend many live events, online events nowadays. So we're going to have what we call the regular sessions, where speakers are going to give structured presentations. And we're going to have also panel discussions concluding each day, moderated by Financial Times. So without further delay, let me pass the floor to Ms. Andrea Moraru. Andrea is the Regional Director of EBRD in Cyprus and Greece. She has a significant work experience, more than 20 years experience in the banking, insurance, and leasing sectors, working in the Central and Eastern Europe, in Russia, Turkey, and in Northern Africa. Andrea holds an executive MBA from CAS. Andrea, we are thrilled to collaborate with EBRD. The floor is yours.
Thank you very much, George, and good afternoon or good morning or good evening, everyone. As I understand that you all over the globe, it's a real pleasure to welcome you to our event on behalf of EBRD. We are thrilled about the number of participants. Thank you very much for joining in such a big number. EBRD engagement in Greece has started in 2015, and since then it's been focusing on tackling the consequences of the financial and economic crisis and assisting in addressing the structural challenges embedded in the country's economy. The bank's activity are intended to contribute to the momentum of its recovery and strengthen the reform process of the Greek economy. The bank has been a firm partner to Greece throughout the pandemic last year. So far, we invested more than 4.6 billion euro in the country since 2015, out of which 800 million have been invested in 2020. In the period up to 2025, the EBRD's operational and strategic priorities in Greece include three overreaching priorities, including strengthening competitiveness by facilitating the expansion of the private sector, supporting sustainable energy and infrastructure, including through further regional linkages, and further enhancing the resilience of the financial sector. We are implementing this strategy by applying a fully integrating sustainable finance approach. Dedicated resource allocation for investments with a high social and environmental impact, coupled with a strong environmental and social safeguards and risk management approach. We support companies and banks to be more sustainable. Our impact approach includes both resource allocation, green economy transition approach, and sound ENS risk management through 10 performance requirements. In every transaction we do, we fully integrate ENS starting at due diligence and throughout the entire project cycle. So by partnering with us, we'll help you to set up adequate environmental and social system and identify and manage your environmental and social risk in an appropriate manner. Where EBRD funding goes, our ESG standards go. By partnering with us, clients will adopt international best practices when it comes to sustainability, ESG integration, and risk management. We also identify added value opportunities to integrate, for example, climate change or other components into projects supported with TC funding. Lastly, we try to support systemically by engaging at the policy level or with the industry associations or stock exchanges, for example, and supporting them with knowledge in order to build up their environmental and social capacity and help with standard setting. We have also training programs for financial institutions and corporate clients on ENS or specific subtopics which we invite clients to attend. Supporting green and sustainable investment is at the core of our mandate in Greece, considering also the country's very ambitious decarbonization agenda. Green projects have been always among the EBRD's top priorities in the country. We supported some of the most innovative green projects in the country across all the sector, from the banking sector to infrastructure and from the real estate to small businesses. Today, climate action needs us to apply across all our activities, and we are stepping up our effort. Green finance will be the majority of our business by 2025, and we also aim to promote equality of opportunity and support of women, young people, and underserved communities, and accelerate digital transition, unleashing the power of technology to bring about the change for the better. In Greece, we've been advancing sustainability in different ways. Most recently, we invested in 2 landmark green transactions in the country. The sustainability-linked high-yield bond of PPC is the first issuance of this kind in Europe to support the country's very ambitious decarbonization agenda. Sustainability bonds are a relatively novel financial instruments. In contrast to a green bond, which is characterized by dedicated green use of proceeds, a sustainability bond derives its sustainability characteristic not from the use of proceeds, but from the sustainability commitment that relate to the issuer's entire business. We have also supported the green bond issuance of Mytilineos, another novel transaction on the green market. Supporting green initiatives by manufacturing companies such as Mytilineos is particularly important because one of the core objectives of the EBRD is the transition towards a low carbon economy in hard to abate heavy manufacturing industry. We supported also the issuance, the first green bond issuance of NBG, the first green bond according to ICMA principles issued on the Greek capital market. We have provided stability support in times of COVID, for example, through our recent 160 million working capital to PPC to ensure stability of energy sector and support decarbonization. In July last year, we supported the Acterna corporate bond issuance with almost 60 million as part of our Greek corporate bond framework. We supported the Greece plans to transition to a greener energy matrix, for example, through our investment in the bond issues of Terna Energy in 2019. We also undertook a case study to look at social issues in Greek non-performing loan portfolios to step up our responsible investment strategy for NPL investment. We supported sustainability in Greek privatization process by designing a state-of-the-art ESG application, measuring ENS performance data for assets managed by the Greek Privatization Fund. While we see many opportunities in stepping up sustainable investments in the next year, they don't come without challenges. Challenges are in relation to rebuild better after the COVID crisis, focus on long-term sustainability business models and increase financing for green and social sustainable, which is our goal by 2025, achieve the full integration of environmental and social matters into the core of every business, and digitalization and changing the way of work. There are plenty of opportunities. We can definitely build back better. Regulatory push, investor demand, and client preferences are changing, and sustainable business models are those that will be successful for the future. At EBRD, we are behind all of this. Thank you, and over to you, George.
Thank you very much, Andrea. And speaking about collaboration and opportunities, before passing the floor to Paul Kidner, let me thank our sponsors who made this event possible. So I would like to thank the IFFR Gold sponsors, Grant Thornton, HSBC, Piraeus Bank, PricewaterhouseCoopers Greece, the silver sponsor, National Bank of Greece, the supporter, Alpha Trust, and the affiliate organization, which is the Athens Exchange Group. I would like also to thank our media partners, the Athens Macedonian News Agency, Athenea, Business News, Capital GR, CSR News, CSR Week, Economia Group, Nafteboriki, Next Deal, and Savvy Investor. I would also like to thank Inventora IT and Hartis for their design and construction of the microsite, the University of Piraeus and the Department of Banking and Financial Management for their hospitality, and last but not least, the IFFR support team, and especially Despina Kontopoulou, our media and marketing officer. May I say that we view our sponsors as collaborators, we call them partners, and we wish to build long-term collaborations with them. So once again, thank you very much. And now I can pass the floor to Mr. Paul Kidner. Paul is the lead advisor to the Tima Charitable Foundation. He has spent more than 20 years on innovative organizations building their strategies, both in the private and philanthropic sector. About 5 years ago, Paul founded and directed People's Trust, an NGO which relieved unemployment in Greece. Paul holds a first degree from the University of Kent and a master's degree from LSE, and he's going to chair our next session. Paul, to you.
Thank you very much, George, for that kind introduction. I'm very excited about today's event, and I'd like to thank you for inviting me to chair this panel. So I won't talk very long. I will pass the floor to each of the speakers. Each of the speakers will have 15 minutes to speak, and then we will go to a Q&A from the floor. So we'll start first with Professor Roberto Rigobon. He is the Society of Sloan Fellows Professor of Management and a Professor of Applied Economics at the MIT Sloan School of Management. He is also a Research Associate of the National Bureau of Economic Research, a member of the Census Bureau Scientific Advisory Committee, and a visiting professor at IESA. Roberto is a Venezuelan economist whose areas of research are international economics, monetary economics, and development economics. And what you probably do not know is that Roberto was part of a rock band in Venezuela, and he reached number one. They reached number one in various stages of their career. So we've got a rock band economist with us today, and I'd like to let you take the floor, Roberto. Over to you.
Good. Thank you so much for that, Paul. Yeah, I'm such a great I was in such a great rock band that I ended up teaching economics. So So thank you, Paul, George, and all the organizers, Andrea, for all the support that you give to this conference. And thank you so much for the invitation. I would like to talk about the challenges of ESG measurement. This is something that is very close to my heart. I have been actually working on measurement. I know that sounds super boring, but yeah, so it is. I spent all my life trying to think about measuring things in life, and it has been actually 23 years since I started. On the inflation front alone, I have spent 19 years measuring the inflation rate. So. And what I've tried to do is to find alternative data sources to do the measurement. So what I would like to do is to talk a little bit what I have learned through that time. And I have been working now 5 years on trying to change the way we measure ESG. And I would like to concentrate on the challenges that we have ahead. So part of what are the things, the questions that we need to answer. So first, let me start by thinking about what ESG measurement is supposed to be. Like, what are these things supposed to be? Now, when you think about firms in general, firms have the ability to touch many different constituencies. They of course, are affect stockholders and bondholders, but they affect customers and suppliers. They affect workers and managers, the public and private organizations. They affect communities, the ecosystem, the politics, the society, and the environment. So in some, they actually have many stakeholders that they touch all of them. Now, what is very interesting is that we measure very well what is the impact of the firm's operations on the bondholders, the stockholders, and the tax authority. Okay, that one actually we measure relatively well. So the financial statements that we produce are trying to be that assessment and captures that such interaction. So now, how do we measure the impact of firms on, for example, on their workers, especially mistreatment? We measure that with turnover of labor court complaints. What about the relationship between firms and customers? Very, very little. In fact, mostly reviews on Yelp and things like that. So it's not like we actually measure that correctly. What about suppliers? Very little. What about communities? It's almost inexistent. And what the environment, I think, actually is almost all self-reported. So to me, we measure even less. So we need to change this balance in some sense. I mean, many people are arguing that or at least many people are upset that firms are very stock price centric. No, they said, well, firms are only concerned about profits. Well, I mean, give me a break. If that's the only thing that they measure, I have no idea how they will be able to concentrate on anything else. So when you think about it, if that's the only thing that you actually are measuring correctly, then you end up actually just managing toward that. And in fact, there's a very old saying in statistical offices that says that you are what you measure. So if you want firms to care about communities, well, the first thing you have to do is to actually measure. And in fact, you have to actually measure. Declaring that you should care about that is not enough. In fact, I always talk about trust. So imagine you have a bunch of people in your building that they don't trust each other because they have been actually hurting each other for a long time. You are in a meeting and then you said, from now on, everybody has to trust each other. What is the likelihood that that statement has any impact whatsoever on the building? Will be zero. In fact, you will look like an idiot. And in fact, thinking that just by decreeing aspects that we are going to actually change the behavior is incorrect. The way we have to change or build trust is that we provide guarantees, we repeat transactions, we observe the transactions, and we do this repeatedly in such a way that we build that trust. Takes time, takes repetition, takes patience, etc. It's not a declaration. So when we think about the aspect of, if we want to change the way firms behave, it's not a declaration. It's not like we have to say firms have to care about the environment from now on. We have to measure the impact of the environment correctly, and we actually have to then make sure that they are, responsible for their actions. So to me, ESG is this is the second aspect. Is that to me ESG should capture the ethical behavior of the firms, and therefore it needs to have an ethical approach. And I'm glad I am surrounded by so many Greeks, because actually ethics started in Greece. So one of the most famous theories about ethics is virtuosity and duty and the ontological. These are all theories that come from the Greeks. We invented a few afterwards, where are consequentialism and the impact that you have. So, but truly, when you think about ESG as an ethical aspect of the firms, then you have to understand that the statements, the procedures, the actions, the outcomes of such actions are important pieces of the measurement of the ethical behavior. You cannot concentrate on one. Exactly the same like ethics. When we look at an ethical dilemma, it's not like, do you have one theory that explains everything? That's not the case. So we actually have different approaches, and we need to actually use different theories to understand the different weaknesses and advantages of a particular dilemma. So I am saying this because, to me, I find myself almost always fighting with practitioners that they say that ESG measures should be just like analyst opinions, okay? And therefore discrepancies among analyst opinions are like differences in opinions. So I think that that's not necessarily the case. ESG measures, in some sense, are going to implicitly indicate that a firm, for example, has a very high likelihood of using human trafficking in their supply chain. I don't think that that's a matter of an opinion, okay? You can have a probabilistic statement, but it's not like, well, I think that you actually, because you're in clothing, you should be using children in your production. That sounds like an accusation. That's not, this actually is a crime, and therefore, in that sense, it should not be a matter of opinions. I find this myself repeatedly discussing these issues. We need to have better disclosure in that sense. In a second, I will talk a little bit about that. But we cannot actually continue thinking of this as an issue of opinions. We need to have some standards, and we have to have some guidance about what to measure and how to measure. So in other words, when our ESG rating agency says that a firm has just emitted 500 metric tons of CO2, that's not opinion. It should be a fact. When a firm is accused of, sexual harassment, that's not an opinion. It should be a fact. And I understand that those facts could be probabilistic or circumstantial. You don't have to have evidence, but it's not a matter of opinion. I think that right now we're not doing a very good job on the measurement of ESG in general. I think that ESG rating agencies are working really, really hard. So don't take me wrong. I think that they are a fundamental aspect of the solution of the problem. This is incredibly broad, and in a second I will say that. But it has been very difficult to get. Right now, they are using very different data sources. A lot of these data sources have different measures and errors in them. There's not a very clear understanding of what should be the procedures to clean that data. We use a lot of alternative data sources to produce the ESG measures, and there's no clear standards. There's very little transparency. In our research, what we find is that by the way, the consequence of this data collection that is a little bit like an organic process of an organic and disorganized process of collection of data, we find that there's massive discrepancy. And this is not only our research, but many people have found that ESG scores from one rating agency and the other are very unrelated with each other. What our research has done is to do analyze that discrepancy. About 50% comes from the measurement of the individual attributes. So this will be measuring labor treatment, measuring child labor, measuring water management, etc. Lying about marketing, women empowerment, things like at that level. We have the granular data. At that level, more or less, is about 50% of the mistakes are made on the measurement. But the other 50% is how that data is aggregated. And these are two things that we need to work. There are different areas to work. So why is ESG so difficult to measure? So first, I want to talk about accuracy. In this particular area, there's no reward for accuracy. So the individual indicators that I just said, like, for example, lying about marketing, stuff like that, there's very difficult to validate those events. So let me do a parallel with credit rating agencies. In a credit rating agencies, you have many credit events, many. I mean, so people default all the time. And in fact, they default in different degrees, small and big. So when we measure all of them, we can evaluate the accuracy of a credit rating agency. So if Paul has a good credit rating agency And Andrea has a good credit rating agency, and my credit rating agency is really bad. Well, it's really bad because I never predict the default correctly. And by the way, just wait 6 months, you will realize that I am full of it, and you will just don't buy my data. I go bankrupt very fast. So when you have many events, especially a small event, is great, because then we can evaluate the accuracy. Now, when you think about it, the ESG rating agencies, they're also trying to measure many things that are small events, also that happen all the time. For example, I talk about discrimination or the mistreatment of women. By the way, I talk a lot about that because this is a big area of my research in which I'm trying to determine and find devices that we and software that we can deploy in firms to be able to measure this a little bit better. But so if I put a lot of examples of that, I apologize. But for instance, when you think about mistreatment of women, they happen every single day in almost every organization in the world. In fact, they're happening all the time. I have no idea why the psychologists call them mini aggressions, because in some sense they don't sound like mini at all to me. But there's a continuous events. They are relatively small in the sense that there are many, but they are not not what leads the person to be incredibly upset. It's not a very big abuse, and so they're called like mini aggressions, and in the end we don't measure them. We actually don't pay attention at all. We wait until the cumulative effect of these mini aggressions is so incredibly high that the person decides either to quit or to file a complaint in the labor court. So you measure this extreme event, which is very large. They tend to be very rare. Okay. Now the mini aggressions happen every single day. The microaggressions happen every single day. And it's the cumulative that leads to that filing of the complaint, and you only measure the last one. So it's very difficult to measure accuracy. And therefore,
Roberto,
in this
just
world,
to notice, we have 3 minutes, please. Thank you.
Yes, I'm going to be done actually in 2. So
okay, thank you.
We have, so we have very, very, very few instances of that. So when you think about, environmental accidents, there are hundreds of tiny environmental accidents. We don't pay attention to those. The second aspect about the ESG measurement is that we have to put things that are very different from each other. And we have to give a score on ethical behavior on attributes that are very different. I will prefer that we don't aggregate, but for some reason, the financial markets needs an aggregation. And I think that complicates the issue, because we need to put firms that are very good on CO2 emissions, but they are very bad on labor treatment, that they are horrible at marketing, but they are great at water treatment. So in practice, the fact that you are good in one dimension is not a license to be bad in another one. So how do we aggregate is absolutely important to understand as a society. How much are we willing to, for example, pollute more if we use water better? So in that question, actually, we need to answer as a society to be able to do the proper aggregation. How much CO2 I am willing to emit to save 2 liters of water? And I understand that we as individuals will like low on both, okay? But that's not what the aggregation needs. The aggregation needs a substitution. So I have no idea how to aggregate those preferences, but this is something that, my research is trying to think a little bit about that. And finally, the disclosure and the transparencies. ESG rating agencies are doing a lot of surveys to try to collect the data, but then there's very little sharing, very little transparency about how that data collection took place. And again, we are duplicating a lot of efforts. And so I always wanted to create the Central Bank of Data, CBD, but apparently that has been taken to be associated with drugs. But I always wanted the Central Bank of Data. So because this is the place where we will collect the data. There's we protect the privacy of the individuals and the firms that we're collecting. We understand how the data was collected, how it was cleaned, how it's treated, how it's created. And then from that data, we are able to construct the indexes that are important. But we need to have disclosure, and regulators need to actually force that disclosure. Disclosure cannot be voluntary. So we have very important challenges ahead. I think that the credit rating agencies are asking the right questions, and they have evolved in a very organic way because this has been kind of a market and competition. I think it's time that we take stock and that we go back to the drawing board and design how we would like to collect this data. Otherwise, we're not going to change the behavior of the firms. Okay, thank you so much. Done.
Roberto, that was perfect timing. Thank you very much for that. There were some things that I'd just like to remind the audience about, is that we can ask questions. So please do so on the chat. We'll collect those and answer as many as we can at the end. I'm sure Roberto's fascinating talk will have raised some questions, and that will give us an opportunity to discuss them later. But I really enjoyed the presentation, Roberto, the fact that a lot of different data sources, that there are a lot of different data sources at this moment, no clear standards, that this is an organic and disorganized collection of data, that there are no rewards for accuracy at the moment, and that there are no consequences for being wrong. That's just some of the, let's say, summary that some of the summary that I've come. Moving on to Maya Henekes. Maya leads the ESG work of the European Bank for Reconstruction and Development with financial institutions and private equity funds. She promotes the integration of environmental and social risks, and opportunities, including climate change, in investment decisions and investment management. Maya designs and supervises environmental and social risk management and safeguard frameworks for a portfolio of over 3.3 billion new approvals per year. She also runs EBRD's ESG training program for financial institutions and private equity firms. There's a lot more to say, but I'll hand over to Maya for now. Thank you.
Yeah, thanks very much, Paul. I will also share my screen to show you very few slides. More than showing you the slides, I want to tell you a little bit more. You've heard already from Andrea in the opening remarks a little bit what EBRD's general approach is to sustainable finance. I think we have a bit of a special position in the sense that our mandate to only finance things that are environmentally sustainable and also socially sustainable was already written down in our founding papers, and that is now 30 years ago. So we've really been trialing, practicing, sometimes failing, and then continuously improving our ESG approach across 30 years. And we've obviously learned a whole lot on the way. And so, as you mentioned, Paul, I have the benefit of working with a very broad range of our financial institution clients, over 500 of them. So I get to see a lot how they then implement our standards, but also, of course, develop their own environmental and social standards. And what I would like to talk about a little bit today is the link between the financial sector and the corporate sector. So how can companies benefit from sustainable banking and an ESG integration in finance? And of course, what we've already heard and what we can see is there is obviously a few trends happening right now. There's a strong regulatory push for greater ESG integration. That's certainly the case for the European Union with the EU Sustainable Finance Framework and all the different directives that have come out of it or are emerging from it. But we also see that it's investors that are demanding a greater ESG integration. So investors just like us, we want to make sure that the money that we or things that we fund that is really structured in a way that satisfies our environmental and social standards and protects our funding also from a non-financial perspective. Then there seems to be evidence out there from mainly academia that also consumer demands are changing. So we're hearing a lot from academia that millennials or other consumer groups are much more interested nowadays in sustainable products or even financial products with some sort of environmental and social robustness attached to it. And so what I can see is that ESG is really becoming some sort of a language between banks and corporations. It is not a common language yet, and that's probably one of our greatest challenges. Roberto has also mentioned it, that there's sometimes, a bit of a de-link of what we mean or what data we look at for coming to similar conclusions. but I think there is a trend to this language becoming a bit more common. So we obviously need to push that trend a bit along. We need to make it faster, and we need to hopefully, in the same way as financial accounting, for example, was created over numerous years, and now we have some sort of agreed standards for doing that. I think we will see the same with non-financial reporting and accounting. And so this common language, it really is beyond just ESG as a what do you say, like a green strategy. I think it really has an E&S risk management standard that is being developed. There's of course the question of resource allocation. So what counts? The EU taxonomy is one example of a framework which is trying to identify and to define what should be counted as green. And then there's of course the tail end, which is the reporting, where we also see at least a trend towards greater homogeneous approach. It's still far from being homogeneous. We have a plethora of reporting standards in the ESG world. But a few trends that we can see is that, for example, the TCFD recommendations are increasingly being included in most of them. And there's a larger agreement on what the different subtopics are, because as also Roberto mentioned, ESG is a very broad field. So we have a lot of topics to tackle. So why should we care about this? I'm probably preaching to the choir here, so I assume most people have dialed in here because they already think that there is some need and some truth to the need for sustainable finance. But I think it does benefit all for sure, because it does minimize environmental and social risks to both the financial institution that provides the funding, but also to the corporation that needs the funding. And it minimizes those risks from a financial point of view. I always find it a little bit funny that we call ESG risks non-financial risks, because to be very honest, I've seen so many projects fail because of environmental or social risks, and they failed largely financially as well. So in my view, there is no such thing as a non-financial risk, but that's what the world right now is choosing to call it. There's obviously protection from legal risks, court cases, spills, contamination. It's expensive, right? So ESG and a good management approach protects us from that. And then, of course, a big issue is reputational. We could all, from the top of our head, count numerous stories of textiles companies where, disastrous events happened, where people were suing in large buildings and they crashed, or child labor, forced labor, large spills, oil in the seas, etc., etc. I don't need to tell you all this, you all know this, but the reputational risks are massive. I was saying that we're coming to one language. There is not one language yet, as I said. There's a number of standards out there. I'm going to use our own standard as an example. It's not the only language that's out there. We call it, we have our environmental social policy, and we derive from that policy 10 performance requirements. But you could in the same way look at the IFC's performance standards, for example, or the Equator Principles. So there's a number of standards out there, right? And I think when we really agree on one language and we implement that properly and then it opens access to finance for a lot of corporations and a variety of finance instruments. So what I'm going to show you is EBRD's performance requirements. And in fact, you will find here a lot of the topics that also Roberto said sometimes are not being measured. So what's the impact on workers? What is it between firms and customers? What is it on suppliers, on communities? So we do measure all those things. We look at them very carefully, and we do it for every single one of our investments. So the first thing we will always do for any corporate, also for any financial institution, we will look at what is their own way of assessing and managing environmental and social risks. Do they have a policy? Do they have underlying procedures? Is this procedure applied through all their business, or is it just applied selectively? How is it implemented on the ground? Sometimes we find, for example, that multinational companies or international banking groups, they have fantastic corporate policies, but then if you go down to the subsidiary level, sometimes sometimes the implementation in an emerging market is not as great, right? So we will look at all of that. Then our second point is labor and working conditions. So we look very carefully at all the labor risks that we've mentioned, but also things like human resource policies, equal pay, fair pay. Are workers, for example, on a big construction site, are they being accommodated far away from home? Does this cause any social disruptions, perhaps in the communities where they're being located for 3 months to build a large wind park, for example? So we will investigate all of those potential impacts and measure them, and then, of course, come up with mitigation measures. We'll definitely look at resource efficiency. That's very important. Water, chemicals, everything that is being used as an input to my production process, we want to make sure it is used in the most efficient way. Health and safety. We're probably, from what I know, we're probably the only development bank that actually measures health and safety major incidents, namely fatalities, in our projects. So we have a database where we record very carefully if anywhere in our investments a car accident happens, another accident in construction happens, we will make sure we know about it. We have contractual requirements for notification of such events, and then we will track it, and we will think about if we find any patterns, or if we see that certain countries it happens more than in others, or in certain industries, then we will come up with ways and how we can address that. Resettlement is a large one, right? For many of our large-scale projects, the resettlement happens, and it's not always voluntary, right? So we need to absolutely make sure, if resettlement happens, that nobody is worse off afterwards than before. Biodiversity, it's a huge one. We know that, unfortunately, our financial accounting does not price in the externalities. It does not price in the cost of natural capital, right? So what we want to do is we want to make sure we know exactly how biodiversity can be negatively impacted from our projects. And then what we apply is what we call the mitigation hierarchy. So we will always first try to avoid any negative impacts. If we can't avoid them, we'll try to minimize them. If we can't minimize them, or what we can't minimize, we'll try to manage appropriately and mitigate as much as possible. And then the last remaining tip of this this triangle, if we cannot minimize, mitigate any further, then we need to offset it. Indigenous peoples, we're obviously very conscious of the fact that not everybody has the same voice, right? So we need to make sure, particularly for minority groups, that protections are in place, and that we understand, for example, how they use the land, what it means to them, what religious value perhaps they attach to it, and then we include that in our considerations as well. Cultural heritage, you know, we do a lot of projects. Imagine when we do perhaps in Greece, some real estate projects, all the cultural heritage we may come up when we start digging in the ground, right? So that needs to be protected, of course. Then we have specific for financial intermediaries, we have a specific performance requirement which lays out what we expect from them. And then the last thing, very important, is stakeholder engagement. I'm going to speed it up a little because I'm conscious of time. So I always say, in the end of the day, ESG integration, I say that a bit jokingly, but lovingly, it's a bit like marriage, right? And then ESG is kind of the love language. So we have an understanding between the investor and the corporation, what we need, what impacts that can be done, and how it can be mitigated. And we will go through a number of steps. Namely, we will look at their systems as an investor. We will look at the policies. We will make very, very clear what governance a company has to address E&S issues. We will include this then in the entire transaction cycle. So we'll perform our own due diligence. We'll have an action plan for everything that needs improvement or amendment. And then, of course, you know, it's a marriage, but we're not entirely being romantic about this. So there are legal agreements, there are covenants that we include to make sure that our requirements will be complied with. And then again, it's a marriage, but we don't trust with our eyes closed. We do monitor a little bit what's going on over the long term of the relationship. Okay, and this is the end a little bit of our specific process. I just wanted to tie this back to what we said about it opens the doors for companies to access finance. We've seen that in particular financial institutions, they have understood that there is a business case behind ESG integrated products or green products or social products. And so if a company takes ESG seriously and sets up good systems, sets up good reporting, collects good data, that will open the door to finance. And there is plenty of instruments out there that can be tapped into. These are ours here on this slide, but in the same way as we offer them, other financial institutions do as well. So everything is available, from green lending to particularly green project finance, green bonds that are being issued, green trade finance, and on and on. So we have a toolkit, we have a lot of instruments, and more we have committed to really greening our finances for sure, but we're also working on generally helping to green, but also make more social the financial sectors. So I think it's a win-win. There is still, of course, a lot of challenges, and we can maybe talk a little bit about it in the questions and answers section of this conversation. But I think we're on the right way, and I think we also need everybody on deck. So I'm really excited about this conference, because we really have here people from the regulators, from academia, from investors, from corporations, from commercial banking. And I think the challenge that we have, it's a societal challenge. It's so broad and so big that none of us can tackle it alone. So I'm really pleased to see all these different groups represented here, and I'm sure we're going to be able at least to move the needle just a little bit further. Thank you.
Maya, thank you. That's great. I'll just let you there share your screen. That's great. Super. Thank you very much. So this has been a fascinating look at also at what the EBRD looks at, and why you look at social and financial risks in terms of minimizing financial, legal and reputational risks, and also the fact that it opens up access to finance. Perhaps that brings me on to moving on to the questions and answers stage. That moves me on to the first question, and if the audience will allow me, I'll make that first question, and then we'll move on to questions from the floor. Isn't this exactly what is also leading to a bit of greenwashing? Because here we're a lot of asset managers in investors are, at least people like Tarek Fancy, who's the ex-executive of BlackRock, as you know, came out saying that a lot of this is greenwashing. There were ESG funds, and basically what we just did was call them, sorry, there were a lot of mutual funds, we just rebranded them as ESG. Is that happening, and is that happening because it's attracting funds? And what can we do as investors to keep an eye out for it and know where they are real and where they are not? So maybe that's to you first, Maya, and we can take that afterwards to others.
No, that's a great question. And of course, Tarek's comments in the press have been widely paid attention to and widely commented, and I think it's interesting.
Yeah.
I agree with him on some points, and I disagree with him on others. Where I agree with him is that there is certainly greenwashing does happen in the market, for sure. Where there's a business opportunity, people will try and find, of course, a way to perhaps take advantage of that. However, I would say once a financial institution or even a company has understood that ESG is more than just a business opportunity, it's also risk management, it's also a strategic approach. And once it understands what the benefits are, I think that takes a lot of this greenwashing away, because only if you do ESG properly, I mean, if you go out and you purchase an ESG rating and say that's my ESG strategy, then of course that does not go far enough. Absolutely, I fully agree with that. But I do think that you can do it right, and you can do it really in a mainstreamed way, where you have you join, for example, decisions about divestment, like we have done at EBRD, we have decided not to invest in coal anymore, even though there may be for a short period of time still a business opportunity. I don't know. We have integrated ESG fully in our risk management. It's part of our standard approval. Every project gets ESG screened. It's not a nice to have, or it's not optative. And we also have commitments then at the resource allocation level, whereby we commit to, for example, dedicating, in our case, we've committed to dedicating 50% of our new approvals by 2025 for green. And there's also obviously another sphere, which is the social investment, let's say private hospitals and so on, which is not captured by that. So I would say our sustainable financing goes far beyond that. But I think once you combine all those three, then you come to a real ESG integrated approach. And I think, to me, that is not greenwashing, because that's when we really also reap the benefits from that approach.
Yeah. So it's integral to your business rather than something you're adding to it. Which makes complete sense. Maybe I can move on then to one last question for Roberta, and then I'll take questions from the floor. You mentioned data collection and creating, and then Maya also mentioned, that there's no common language yet, and that this seems to be a common theme, even for Bentel Green Oaks. There are differences between the regions in how they report, if I understood correctly. So, what can we take from this? Is there a way that we can begin to look at this data collection more uniformly? And are there standards that you know of out there that are moving towards that?
Okay, so short question. It will be a very long answer, so let me just try to be short. Yeah, there are organizations like SASB and that are trying to create those standards. I think that in the end, these standards the objective of these standards is to create some aggregate score at the end, some responsibility index, any way you want to call it. That in the end, I think is it leads to a lot of simplifications. When I read that, for example, SASB categorization, they put together paying taxes with lobbying activity and corrupting officials. I don't know, but that sounds like three very different things, So I can be paying taxes and be totally corrupt at the same time. So how do they treat that? So the standards, again, because they're trying to aggregate the data. And again, I am very sympathetic to what Maya and Anna described. So, for example, because at the end you have to make a decision, and the best way to make a decision is to try to aggregate. Now, the way Anna and Maya are doing that is by looking internally to their organizations and thinking, what are my values? And therefore, understanding what those values are, then I can actually try to make those trade-offs. And therefore, you have to understand if they do better in labor practices, but worse on indigenous rights, which were two of the ones that Maya was highlighting. I mean, are you willing to accept someone that improves in one and deteriorates in the other? I mean, following a little bit what Anna said about the time trend. So this is where you are. Do you expect improvement on all of them, and so on? I think that those questions are very difficult to answer if you want to have one single answer for the humankind. I think it's just like incredibly difficult to answer. I run these experiments trying to think about what are the values of individuals, where I ask them to play games and allocating resources between two incredibly conflicting objectives, like civil rights and the other one is CO2. And, people don't even know when they start. So I think that creating those standards will require a lot of research. Before that, we need to actually make decisions. And for that, I think that it's okay to take certain, what I will consider a shortcut, but is some common sense way to do it. Let me point out something very interesting about greenwashing. I like engagement a lot. I don't think that the world can help with negative screening. So I love when Anna said, like, we are all about engagement, not negative screening in real estate, because truly, I actually think that, I mean, there are some areas in which a negative screening makes a lot of sense. I mean, like, you know, drug dealing.
Yeah.
And so
That makes sense there.
I mean, there are some that will be easy, but for example, construction, transportation, I mean, we need to help these organizations change. And the best way to change them is to finance them and condition. So be active. I mean, in fact, if you look at what Maya and Anna described, which what I like about those presentations, is that capital is not passive. We should never be passive, by the way. What a waste of life. You should never be passive on anything. Talking about marriage, be passive on a marriage and you will see what happens. Never be passive, and capital should not be passive. Regulation should not be passive. Investors should not be passive. Consumers should not be passive. We should be active, all the time active. Yeah, and by the way, this passive strategy, unfortunately, is super profitable. So all the funds are moving to passive strategies, but that is just preservates the mistakes that we made in the past. We should be active. And these are two examples of activism somehow. I prefer engagement because I cannot imagine the world without many of the activities that we have today. And maybe I'm not creative enough, but as far as I think about it, the solution goes through them. So the ESG rating agencies, we need to improve them because they are going to be the conduit to simplify this complexity that is so difficult for us to read.
Yeah,
we need to make change incentives in such a way that we get more transparency, more sharing, etc.
So actually, what I hear you saying, and I'm just reflecting on a question that is being asked of you here, is it's not bad to have divergence in ESG ratings, but actually that engagement of the different ESGs and the discussions that we're having will finally lead to perhaps a global understanding, or at least a regional understanding of what ESG ratings are. Would you agree with that?
Well, yes. I mean, the disagreement could be on the following. Let me tell you the healthy disagreement. Mm-hmm. If the five of us that I'm looking now on the images, if I ask us how much do you weight CO2, women empowerment, marketing manipulation, and product safety, we all five are going to have different weights.
Yeah.
So we have different values. And by the way, we will have different values depending on what happened to our lives. Then you have kids, the values changes. The day you retire, then you only play golf. In any case, so the idea is we have five values. But if we all ask the question, do you want to improve in one of these dimensions? We all have agreement. So in other words, if we all five decide to discuss what is the world we want to build, we will find a lot of agreement.
Yeah.
You see? So that's a healthy disagreement.
And
where we said, well, there are different weights, so there are different trade-offs, but we agree on the objective. Right now, we're not having a discussion. In almost every country, the discussion is about destructive policies. I mean, find any country, pick a random country where they speak any language, okay? And look at the newspaper, translate that, and it's probably they are talking about destructive agendas, what they don't like about each other. So,
although I think
disagreement.
I think there are dialogues being handled, and for example, the G7, agreement not to fund coal, for example, in other countries is one of those dialogues, interesting dialogues that is happening. So,
well, can I just add one point to that?
Yes,
I think,
of course.
I agree with Roberto that there's different values and we probably all weight things differently. But what we, I think, also can achieve, at least that's the way we would do it, for example, with any client of ours, is we agree on a minimum threshold. So there is a certain threshold under which we will not invest on any of those topics that you mentioned. So then I think if you have clarity, what's your minimum threshold for all of the topics that are important, you can then go beyond in some of them, you can stay closer to the threshold on others, but you're also very clear where you have no tolerance.
Maya, I have a question for you here. There are
no
some
ratings for me.
Yeah.
I do site visits. I don't buy ratings. That tells me much more about an investment usually.
Here we have a question. There's some discussions from policymakers on taxing banks which fund brown firms. What is your view on that?
I think we need a price on carbon. then the markets would be taxed for brown or for carbon, not just perhaps one market player as such.
Mm-hmm. Okay, and I'll move on to another question, which is interesting. Is the G feature of the great forgotten one among the 3 features of ESG? And this is for all of you. The new EU draft contains 1,186 indicators to measure ESG corporate activity. Is it too much to be workable? So, Maya, go ahead, and then someone else can answer.
Oh,
Roberto,
I work at the census. We collect hundreds of thousands of indicators, and then we work on dissemination. So I don't see a problem. And by the way, no, G is not forgotten. G receives a lot of attention. I mean, so in fact, I think that Anna presented tables. So I mean, I don't know, one of the presentations I saw, there were many concepts that are on the G side, and actually on the list that Maya showed, there are combinations of G and S. So no, I don't think the G is forgotten. And again, I have no problem measuring 2 million things. That's fine. We're used to do that. This is called statistical offices. But then we produce reports, and we trust those statistical offices. There's the transparency on and how we produce that. So I don't see any problem collecting thousands. Now, if you're hoping that to get the 1,000, release all of them to every individual investor, and then hoping that they will understand what each 1,000 of those indicators are actually measuring, when there's no documentation whatsoever and no standards whatsoever, then that's worse than actually not providing data at all. Yeah. But yeah, that's why I want the CBD, but not the drug part, but just the central bank of data.
And of course, the question then is that, or rather the point is that what you don't measure, what you can't, improve what you don't measure. So I think that goes to your point there. Okay, Maya, did you have anything to add to that, or?
No, I think I agree that G is certainly not forgotten. I think actually it is probably the most regulated of the 3 because of the compliance approaches and everything. So legally, maybe it's captured even better. I would say what's lagging behind currently is the S. I think we've gotten quite good at measuring the E. We have, tried and tested carbon emissions calculations and all that jazz. The social gets more difficult, and we see also the EU taxonomy is a good example, right? It was impossible to tackle the E, the S, and the G all at once in one list. So they started out with the E. There is a minimum safeguard for the S, but it's not a social taxonomy at this point. It probably will. There may be one in the future, but I would say rather we need to pay a bit more attention to this, especially now with the experience of the pandemic, which has really shed the light on the S, I think, much stronger.
Thank you for that. I'll take a question from Gonis Alemon, a Senior Risk Manager, Nationwide Building Society. So he asks, with the advent of the UK climate stress test, can you comment on the approaches adopted by and challenges faced by financial institutions to quantify the impact of physical and transition risks on their balance sheet, perhaps with a focus on residential and commercial real estate? So I don't know whether that is.
I can give a general answer. Maybe Anna can comment a bit more on the real estate sector. So yeah, I think financial institutions, we all know now we need to move into being able to do a portfolio review. We've already been quite good at doing climate risk assessments on a project by project basis for a specific project location and so on, project finance deals. But on a portfolio level, we're figuring this out as we speak, and most of the financial institutions are figuring it out. The more asset classes and the more subsectors you lend to or invest in, the more complex it gets, obviously. So let's say probably for Anna's company, because they are obviously specialized in one specific sector, it's probably already a bit more advanced than for somebody like us, we're developing our own approach currently to do a comprehensive climate risk assessment for our portfolio, but we invest in literally everything except for those sectors that we have specifically excluded for ethical reasons. Right. So it's not easy. The instruments are not fully developed yet, or the methodologies, I should rather say.
Another question from the floor, Thomas Barbara, risk manager, Morgan Stanley. Do any of the participants have views, or have you done work on how to measure ESG for sovereigns? I see Roberto shaking his head. No. Anna, no.
We lend 80% to the private sector, so not really.
Okay. All right. All right. Let me just take a couple more questions. We just have 2 minutes, so I'll take one last question from Cronmiller Ted here. What are your thoughts on prospects for amendments to EU securitization regulation and the capital requirement regulation to integrate sustainability factors and their impact on risk-based capital adequacy? Roberto?
I think that the best way, if we're expecting the regulator to tell us how to include CO2 emissions of my portfolio on the evaluation and the cost of capital, I think that's a horrible path. I mean, the best way, I think Maya said, let's just put a CO2 tax, and then it will be part of the cost, and that's it. And then, you know, there are some property rights that we can create. Let's create the property rights and we trade them. And therefore, when you do something that is costly and the externality happens, we will be able to measure. For the things that we cannot put property rights, like labor treatment, we force disclosure, and then we allow the market to decide what should be the market capital for that. So we just have to have the disclosure. The regulator should just be saying disclose, period. And then the market should be able to, but by the way, there's some standards on the disclosure. So it's not like disclose and say whatever you want, you know, disclose and there are some consequences if you lie. But if we are expecting the regulator to tell us how the securitization has to happen, how to include these issues into the evaluation, I think that, I think we should just change profession.
So it's about transparency, going to one of your first points, transparency and allowing the market to work.
I don't think that regulators have a comparative advantage in understanding how electromagnetic field pollution should impact an electric company. Okay. I mean, I am an electrical engineer, and I'm pretty sure I understand electromagnetic field pollution. I have no clue how to include that. Now, why some regulator that has no clue is going to tell me how to include that? I think the market should.
I think we see a few trends in that direction. We see it obviously from the efforts of the central banks to require climate risk assessments and disclosure of climate risks. So that is one component where I think it's starting to sneak in. And then, of course, in the EU, again, we have now, and as Roberto said, they're coming from the end tail of this. So we're starting to have disclosure requirements for environmental and social risks. And while as of today, to my knowledge, there's not yet a clear link yet to capital adequacy, but you will have to disclose environmental and social risks. So it's coming slowly, I think.
All right, I think I will have to wrap it up there, although we could go on for hours. I want to thank you all for a very interesting and well-presented discussion. Thank you very much, Roberto, Anna, Maya, for your contributions. Thank you.
No, thank you for the invitation.
Thanks for having us.
Maya and Anna for sharing. Thank you.
Thank you.
Thank you, George. Bye-bye.
Goodbye.
Okay, great. Thanks a lot, Paul, and thanks all our speakers for their fascinating talks and for expressing so interesting views.